The broadcast is now starting. All attendees are in listen-only mode.
Hello, good morning, good afternoon, good evening, depending on what part of the world you're in. Welcome to the Wilkin and Gutton Plan webinar on international tax implications of the Tax Cut and Jobs Act. This is the third of the series of 4 webinars about this new law. My name is Vinay Navani. I'm a tax partner at Wilkin and Gutton Plan, and I will be presenting this webinar along with my associate, Darko Namowski, of our firm. So you've probably been reading about all sorts of aspects of this law in the headlines. If you heard Monday or Tuesday's webinar on individual and business tax changes, you saw how complex it is. I will tell you, in the international arena, it is a complete rewrite of the rules. This is certainly the biggest change we've had since 1986 in how the U.S. taxes international transactions. So there are just a lot of new concepts to learn. And because of that, we're going to keep this at a very high level, focus on concepts. We're going to use a lot of terms that are not correct for the sake of helping getting these concepts across, and we hope that you enjoy it. So a few housekeeping rules. Many of you are looking for CPE or CLE, so you know the drill. You have to answer the questions as we post them in order to get the credits. There's the GoToWebinar dashboard that allows you to ask questions. We encourage you to ask questions. If possible, we'll try to respond during the webinar itself. Otherwise, we will email you after the webinar is over with our thoughts on your questions. And like most of the things in this new law, there's a lot of things that we just don't know the answers to. So we have to deal with each of these things as they come in. So just a brief overview. The Tax Cut and Jobs Act was signed by President Trump on December 22nd. The House and the Senate came to their agreement late on Friday afternoon, December 15th. And since then, we have been trying to sift through the 1,000 pages of legislation, trying to understand all the changes. There was a webinar on Monday about individual tax changes. There was one last Tuesday on corporate tax changes, which also included pass-through entities tax changes. And then the last major section is the international tax changes, which is what we're going to be talking about now. So here's the agenda for what we're going to be talking about today. We're going to start by, Darko's going to give us an overview of what's the current U.S. tax system for international transactions. And then we're going to talk about 4 or 5 brand new concepts in the law that you have to understand if you're going to practice in this area or have business operations outside the U.S. One is going to be the dividends received deduction for foreign dividends. One is going to be the deemed repatriation tax, which impacts anybody with offshore income. Another is a new acronym, GILTI, and as you can tell, that doesn't sound like a good thing. The next concept is FDII, which we'll talk about, which is a beneficial deduction. There's going to be a hodgepodge of other miscellaneous international tax changes we'll talk about. And at the end, we're going to wrap everything up and think about what are some of the key concepts you want to take away from this, and what are the planning opportunities that the change in the law has given us. So with that, I'll give it to Darko to take over.
Thank you, Vinay. And good morning to everyone, and welcome to this webcast. Thanks for joining us. So just to give us a little bit of an overview of the currently U.S. tax law prior to the enactment of the Tax Cuts and Jobs Act. So as we all know, U.S. individuals and businesses are taxed on their worldwide income as they earn it. This includes U.S. earned income and foreign source income. One exception to the foreign source earned income from being taxed is if that foreign source income is in a foreign corporation. At that point, that earned income is deferred until there is a repatriation via dividend. So as you can imagine, a lot of companies, due to lower tax rates or fear of double taxation, have set up corporations overseas where they operate and hoard a lot of the profits and keep a lot of the cash in there.
Darko, what is that on that country over there? I think that's Ireland. What is that?
That looks like a big old piggy bank, and that's a great question, Vinay. And the reason that I was going to get to that in a little bit. The reason that is a big old piggy bank in Ireland is because, as we know, or should know, seen in the news or otherwise, Ireland has one of the lowest tax rates of the developed countries, which is 12.5%. So we know all the Googles and Apples have either set up their subsidiaries there or have actually inverted their companies. That's a term that is keenly used in international taxation, where the headquarters have been moved to a foreign country. They've inverted their company to be headquartered in Ireland, and all the income that is earned is hosted and pay tax in that country. So we show this illustration because it shows how companies have not brought back cash into the US, and that's why that big old piggy bank is in Ireland. This is somewhat of a dysfunctional behavior because now US operations are, for lack of better word, cash poor and may need to borrow money to fund their operations. So a lot of the other foreign countries, developed countries, have enacted laws, tax laws that use the territorial tax system. And this territorial tax system taxes income that's earned in that country only. So in an attempt for the U.S. to, to discourage this dysfunctional behavior and to get along with the most of the modern world in form of taxation, we've tried to move to a territorial tax system with this new tax law. And the territorial tax system has a few nuances, and we'll talk about more about that in a minute. But one important term in the foreign taxation is the controlled foreign corporation, which I'll dive into here in a second. But before I do that, Vinay, do you have anything to add on here? On this slide?
No, I think that okay. This is good. We have this is the current scenario, and the policy rationale behind this tax law change, it seems to be to get away from this.
Exactly. So the reason we want to talk about the controlled foreign corporation, because it's intertwined with the new law, and it's imperative to understand what this is before we continue on. So what is a controlled foreign corporation? Well, it's kind of exactly what it says. It's a foreign corporation that is controlled. But who controls it is the question, and as you may guess, in order to be an important factor in U.S. taxation, it would have to be controlled by a U.S. person. So by definition, in simplified terms, it's a controlled foreign corporation is any foreign corporation if more than 50% of the foreign corporation is owned by a United States person or shareholders by vote or value. It's important to note that indirect and constructive attribution rules apply here. And then the second question that comes to mind after you see this definition is, what is the definition of a United States shareholder? And a United States shareholder is any person, including entities, trusts, or businesses, who is a 10% owner of the foreign corporation.
So, Darko, does that mean if you're talking about an individual, do they have to be a U.S. citizen?
They do not need to be a U.S. citizen. This can be a U.S. resident also. So therefore, any green card holders will be subject to these rules as well. Last item that we want to mention here is that in order to obtain control or a foreign corporation to be controlled by U.S. persons by 50% or more, these U.S. shareholders do not have to be related, could be unrelated. Okay.
So Darko, if I understand that, if I own 30% of a foreign corporation and my next door neighbor who I don't like, who I'm not related to, owns another 30%.
Yep.
Do we have a controlled foreign corporation?
So let's look at the rules. You own 30% and you're a U.S. person. Now, what we need to ask is your neighbor a U.S. person or is this a foreign person?
Let's assume that he's a U.S. person.
If we're assuming if this is a U.S. person, then his 30% and your 30% make it 60. That is definitely over the 50% of vote or value, assuming that's what we're looking into. So your foreign company would be considered a controlled foreign corporation, and you would be subject to the rules of CFCs. Okay, so let's move on. That's what a foreign corporation controlled CFC is, and let's just see how this CFC is being taxed in the U.S. As I mentioned earlier, a lot of U.S. multinational, either taxpayers have set up the CFC to defer any income being taxed in the U.S. So what are the taxable events for this type of entity? There's three major taxable events, and we'll go through them, and there's some other small ones, but for the purpose of this presentation, we'll go through the main one. The first one and most obvious one is whenever that foreign corporation issues a cash dividend to the U.S. parent or U.S. shareholder. That is being taxed as a dividend in the United States. Actual cash repatriation. The second one that is more prevalent is the income inclusion under Subpart F. As I mentioned earlier, all the income earned by a CFC is deferred until repatriated. Congress has enacted laws, I think that date back to 1962, Vinay, to discourage some dysfunctional behavior, or what we call a anti-deferral regime. So Subpart F, what essentially does is it triggers income earned overseas to be taxed in the U.S. without having an actual cash distribution. Vinay likes to call this preventing bad behavior by U.S. corporations or U.S. taxpayers, and the system certainly has done that. So with that, I mean, I want to throw it back to Vinay. Maybe he wants to add something here.
Yeah, I'll just say the Subpart F rules have been around since the 60s, and they really kind of have the genesis of the economy back then. And the idea would be that if I was a U.S. manufacturer and I set up a subsidiary in Spain, and that subsidiary in Spain was selling goods to Italy, but they were simply buying, the Spanish subsidiary was buying goods from the U.S. and then selling them to Italy. The thinking was, well, why do you need a subsidiary in Spain? You could have just as easily done that from the U.S., and therefore that would give rise to what we know as Subpart F income, which is effectively treating the income of that Spanish subsidiary like a partnership. And you would have current income on your U.S. tax return, even though no cash had been received. So that's the concept of Subpart F. That's an entire area of taxation that we're not going to get into, but those rules have not been changed, and that is something that still exists.
Okay. Excellent. Thank you, Vinay. And the third major triggering event for U.S. taxation is the investment in U.S. property under Section 956 rules. Talking about dysfunctional behavior, whenever U.S. multinational taxpayers had loads of cash overseas, they were cash poor in the U.S., they started, rather than repatriating these money as dividends, they started loaning monies to their U.S. Affiliates or parents. And Congress saw that as unfit and said that if you do that, we will tax that as a deemed dividend to your U.S. shareholders, and therefore put a stop to that. So these are another set of rules that any investment into U.S., whether it's stock, cash, loans, or anything like that, or investment in property, may trigger a taxable event for a U.S. shareholder owning a CFC. Anything else to add here?
No, I think that's good.
Excellent. So with that, we're going to wrap up our current system of taxation for U.S. multinationals and their foreign operations, and we're going to go into the first of our four major new law attributes, and Vinay is going to talk to us about the foreign dividend received deduction.
Thanks, Darko. So this is one of, as Darko just said, this is one of the major new concepts that's come into the law. The map that Darko just illustrated showed that behavior of the tax motivation to keep money offshore. What this provision is trying to do is it's trying to move us to a territorial tax system. It's really not a full territorial tax system. It's a quasi-territorial tax system, and you'll understand why in a minute. So the way the system works is the dividends that a U.S. corporation receives from its foreign subsidiary are still taxable. That hasn't changed. What has changed is we have a new code section, and as accountants we love code sections, and it's code section 245 Cap A, which provides a special deduction. And this deduction is it's a deduction to completely offset the dividend income that's received that is from a foreign subsidiary. And the subsidiary that pays the dividend either has to be, at least we have to have an ownership interest of at least 10% in the foreign corporation. So it doesn't necessarily have to be a CFC. I can be a U.S. corporation and own 10% of a corporation, which is 90% owned by other non-U.S. people. But my dividend will be subject to this dividend received deduction. It's also in some authority referred to as the participation exemption. You may hear it, that term used too. You have to hold the stock for at least a year. Now, here's the real issue. This dividend received deduction applies only for C corporations. So if you own a foreign corporation in any other type of ownership, whether you own the foreign corporation individually, through an S corporation, through a partnership, through an estate, through a trust, you will still be taxed on the dividend received, but you will not get the benefit of this offset. So this is kind of the first of several instances we're going to see during this presentation that there is a bias now, I think, in the international tax area to hold your foreign ownership through U.S. C corporations, even though in the world of closely held businesses, which is where a lot of our clients are, we tend not to use C corporations. We tend to use pass-throughs. There are some real benefits in the international arena for C corps. So this is the first of that example that we're going to see. It is effective. This benefit's effective for distributions made after December 31st, 2017. And the subpart F rules that we spoke about a few minutes ago still remain in place. So you still might have that acceleration of income, but it is possible now to plan around the subpart F income. So go ahead.
So Vinay,
yes.
If I'm a U.S. taxpayer and I receive a dividend from a country that is not a treaty country, and we don't have beneficial rates of withholding, what happens to my withholding tax or any foreign taxes I paid?
So if I'm not paying any U.S. tax on the dividend, I don't get a double benefit. I also don't get a foreign tax credit. So that's something to keep in mind, that the foreign tax credits associated with a dividend that you get this benefit for basically go away. Okay, thank you,
Excellent.
Darko. Now let's go through an example. So in our example, we have a foreign corporation that has taxable income. I'm sorry, we have a U.S. business that has taxable income of $100,000 that also receives a dividend from a foreign corporation that it owns at least 10% of $20,000. So we've got two columns. The column on the left is what if that foreign corporation is owned by a C corporation, and the column on the right is what if that foreign corporation is owned by something other than a C corporation, an individual, an S corporation, a partnership. So in both cases, I have my starting point is my taxable income of $100,000. I have my $20,000 dividend. So now let's focus on the column on the right. My taxable income is $120,000. I'm computing income at the new individual rate of a top rate of 37%. I'm adding my net investment income tax of 3.8%, and I have a tax burden of $45,160. Now let me go to my column on the left. I have my same $100,000, I have my same $20,000 of my foreign source dividend, but now you see on that third line, I have a dividends received deduction of $20,000, making my taxable income of $100,000. On that, I use my new lower C Corp rates of 21%, no net investment income tax for a corporation, and I get to a tax burden of $21,000. Now, for those of you, some of you may be thinking, well, that's not really a fair comparison, because to get the money out of the C corporation, I have to incur another level of tax, which is the main reason why we tend not to use C corporations in the closely held environment. And that's 100% correct. I just left it this way to kind of illustrate the difference in the $20,000, how that deduction is not available in the non-C Corp holding environment. So now that takes us to our first polling question. And the polling question is, the foreign dividends received deduction is available to individuals, S Corps, C Corps, all of the above, or none of the above. So if you need CPE or CLE, it really is important that you answer, and we're going to wait for about 10 seconds to give you a chance. And Most people have voted, and fortunately, most people are paying attention. Okay, Amanda, let's close it down. Thank you. And of course, the answer is that it's only available to C corporations. So now with that, we're going to talk about the next big area of this law, and that's what Darko is going to take over.
Thank you, Vinay. So, as Vinay said, we were going to jump into, I would say, one of the biggest areas of this new tax law that has a lot of us professionals scratching our heads and trying to understand what it all means and how to adjust for it. So, on the outside looking in, this part of the tax law is a toll charge or tax on any unearned, on any accumulated earnings and profits post 1986 of these CFCs that were deferred up until now. So what this tax does is really pay for this legislation for all these tax cuts and kind of levels the playing field from the prior system to the new system. So let's just dive in a little bit and see what it all means. The Congress has amended Code Section 965 to put in a brand new code section for this repatriation tax. Previously, back in 2004, they had a similar provision, similar measure that allowed companies to voluntarily repatriate their foreign earnings at a reduced rate. And that's exactly what this system does. However, it brings it in as a mandatory deemed repatriation rather than a voluntary. So let's just look at some of the language and then we'll talk about it in more detail. So repatriation tax is a deemed repatriation by a U.S. shareholder of all accumulated post-1986 foreign earnings of 10% owned specified foreign corporations. There's the first new term in this legislation from this act is a specified foreign corporation. What is that? Well, a specified foreign corporation would be any CFC, which we talked about earlier, and that's why that was important, any controlled foreign corporation. And then it adds another layer of entities that will be subject to this is any non-CFC or any foreign corporation where at least one shareholder is a domestic corporation. Let me put that into perspective a little bit with a quick example. Assume that you have a foreign corporation where an individual has invested about 15% of their stock by vote or value. And we don't really know what the rest of the shareholders, who the rest of the shareholders are, and we've been picking up the dividend income as it's been distributed to us. Now this law comes into place, and now we have to look through to all the shareholders to see whether any of the other shareholders in that foreign corporation is a domestic corporation. If that is the case, this individual shareholder, which owns 15% of this foreign corporation, has a lot of homework and paperwork to do in order to calculate the earnings and profits of that foreign corporation and include that income into their 2017 income tax return. And we'll talk about the effective date in a little bit, but that, in essence, that's what this law does. So when we talk about income inclusion of all of these accumulated earnings and profits, and we talk about reduced tax, we need to talk about what that reduced rate is. And the reduced rate equals 15.5%. It's a twofold rate for cash and cash equivalents, and 8% on the remainder. The question then becomes, what are cash and cash equivalents? Well, cash, we know what that is, and we may have to dive in a little bit closer to find out what that is, but it also includes accounts receivable netted from accounts payable. It also includes short-term loans. It also includes readily available securities and derivatives and CDs. So it's not just cash, it has a little bit more than that. And the way it works is if the cash and cash equivalents are taxed first, and then at 15.5%, and then the remainder is taxed at 8%. the mechanism that the legislation has used for this tax is not via a flat rate, however, via a deduction that effectively would get us down to 15.5%. If you make the math, if you do the math and you're quick on your feet here, you will notice that to get to the 15.5%, you need a 55% deduction, around 55.7, and in order to get to the 8%, you need about a 77% deduction to get there on that income. So, last question or last item on this slide is, this tax applies to all shareholders, whether you're an individual, a corporation, a shareholder in a S corporation, and we'll talk about that in a little bit more, or whether you're a partner in a partnership that owns a company overseas. Winay is waving at me. Winay, you have something
Darko, I have a
add.
question. There's something I don't understand. The dividend received deduction, which was the benefit that was going to get us this territorial tax system, is available for C corporations.
Correct.
But your last bullet here applies to all U.S. shareholders. Does that mean that if I'm an individual and I own a CFC, I've got to pay this repatriation tax, but I don't get the benefits going forward? That doesn't sound fair.
Vinay, you've been paying very good attention to our webinar here, and you are absolutely correct. And a lot of professionals and businesses, especially individuals who own entities overseas, are looking at this and saying, why am I being penalized? And the best explanation we can give here is that the Congress, in their attempt to level the playing field for U.S. businesses to compete overseas, kind of went a little bit overboard, in my view, and penalized individuals a little bit more than they intended to do with this legislation, with the foreign legislation.
Okay. Well, hopefully you'll have some more good news coming after this.
Let's just keep going and see what it does. All right. So this, as you can imagine, would put a big tax burden to all taxpayers that have accumulated earnings and profits from foreign operations. So Congress was kind enough to give us a spread over which we can pay this toll charge. The tax is due with the filing of the 2017 tax return, calendar year tax return. However, it can be spread over 8 years, as it says on the slide. It is a little bit backloaded, which means that for the first 5 years, you pay 8%. Year 6, you pay 15%. Year 7, 20%. And year 8, 25%, which gets us to 100% of all taxes due in year 8.
Darko, maybe I misunderstood you. Did you say 2017?
Vinay, you heard me right. We're talking about tax calendar year 2007 for tax returns 17. For tax returns due April 15th or 17th with the holidays, 2018, that is less than 3 months away.
Oh, no.
I'm assuming, we're thinking a lot of our taxpayers will seek extensions, and we're hoping that the IRS will not impose the hefty late payment interest and penalties for this tax. That's remained to be seen via future guidance. Next to talk about is exactly what you said, the effective date of this legislation. It is, in technical terms, the last taxable year of the foreign corporation that begins before 1/1/2018. And many of our taxpayers that invest in foreign corporations, their tax year are calendar years, same as ours. So that means that if the year began in January 1 of 2017 and ended in December 31, 2017, we have a income event for all of the U.S. shareholders that have 10% ownership or more, given that there's at least one domestic corporation. The calculation of earnings and profits, there's another twist in here, is the greater of the earnings and profits as of 11/2/2017. If for the CPAs and attorneys in the webinar, you'll remember that this is the date when the House passed its bill. And then, so and the second measurement date is December 31, 2017. So in our view, they try to prevent any discouraging behavior on reducing earnings and profits during this period of enactment by the House. What's important here is that if you have a CFC or a specified foreign corporation that has deficits or has been losing money, you can use those deficits to offset some of the income against the earnings and profits against the profitable entities. So, Vinay, before I get on the next slide here, anything here to add on this slide? What I will say is on the second bullet is that wherever we have foreign entities that are on a calendar year basis, there is a possibility that some U.S. taxpayer may have a income pickup in 2018 and 2017, depending on where that year falls. So imagine, I mean, it could be a straddling event where they have income pickup in 2018.
It could be, but I'll just give you my thoughts are that as a practical matter, with many of our clients, the focus has been up to now has been avoiding subpart F income, and assuming that you're able to do that, the rest, we report the foreign financial statements of the foreign subsidiary in most cases on our IRS form 5471. But I will be honest that there's really not been a great motivation to really drill down and calculate earnings and profits exactly when you have a company that A, doesn't have subpart F income, and B, is not actively paying dividends. You might have a subsidiary that acts as a back office that really is operating on a cost-plus model that's really not generating a lot of income. So there's really not been, in many cases, not been a whole lot of attention paid on determining what the E&P is. Well, now that's going to change dramatically. We really have to get our arms around what is that E&P. E&P has specific rules under the U.S. tax code, which is not the same as the financial statements, retained earnings. So that's going to be a major challenge between now and the extension due dates to figure out how much tax we may be owing.
Exactly. Thank you. So just to continue on with some of the items here, this repatriation tax applies regardless of movement of cash. And once this tax is paid, you're thinking this is free cash to us, but businesses should be careful here because you may be incurring some foreign tax withholding from dividend payments from a foreign corporation, and those credits may not be available to you upon distribution. So proper planning should be done in terms of that.
Right. I'll just add back, I think it was 2004, there was a preferred rate to encourage the same type of behavior of bringing cash back to the U.S. and taxing at a lower rate. But what happened was nobody did it. And it did not create the kind of revenue and the kind of cash inflow back into the country that the government was expecting. So that's why I think the government has now taken a different approach, a deemed approach, saying we're going to tax you, and you make a separate business decision as to when you're going to bring back the cash. Obviously, the hope is that by the fact that money's already been taxed, it'll be easier for companies to bring the cash back.
Yeah. Agreed.
Okay.
So you're thinking that once this tax hits, that most of these U.S. taxpayers will owe 15.5% or 8% tax. That is correct, but however, there's some relief here because Congress has allowed the use of foreign tax credits for foreign taxes paid in these foreign countries. However, keep in mind that these will be prorated based on the percentages that the rate is reduced. So for a cash and cash equivalence tax of 15.5%, the foreign taxes equivalent paid to that foreign country will be reduced by 55%, and then 77% for the illiquid assets. These foreign tax credits are generally available to corporations and not individuals. However, Congress was kind enough to enact Code Section 962, and via election, an individual can subject themselves to the corporate rates and foreign tax credit availability via this election. What a 962 election does is exactly what I said. It allows individuals to be taxed as corporations on their Subpart F income. And the reason Subpart F income is important here is because the whole repatriation tax regime is brought into income via the Subpart F regime. So it acts as an income item that's taxed at special rates. So once an individual makes this election, this 962 election, they'll be able to claim some of the prorated foreign tax credits. Final question that we pose here is, how are these states going to treat this? We've been talking about federal taxes and federal income, but every state, and especially the Northeast states, have different rules as to how they treat Subpart F income and now this new repatriation tax income. And since we're giving this webinar from New Jersey, where the tax rate is 9%, we definitely need to take a closer look here to see how this will be treated for the two types of tax in New Jersey. One is the gross income tax at the individual level and the corporate business tax at the business level. And we're yet to see specific guidance, although we have some knowledge as to how this will be treated. Vinay, do you want to add something?
I was just going to take a step back for those participating who are not from the U.S. Just as background, in the U.S. we have effectively two levels of tax. We have the federal tax, which is everything we've been talking about thus far, and then most of the 50 states have their own state income tax, which may or may not be connected to the federal system. In New Jersey, we kind of actually have both. We have New Jersey corporate system, which is tied to the Internal Revenue Code, and we have a personal tax system known as gross income tax, which is independent of the Internal Revenue Code. So we're wrestling with these issues at a federal level, and we have to wrestle with these issues on a state-by-state level because it's unclear as to how states are going to follow this new all these federal rules.
Okay, thank you, Vinay. So earlier, when we talked about to whom this tax applies, we talked about individuals and corporations and partners in the partnerships and shareholders in S corporation. And one of the inexplicable or head-scratching items in this legislation is that this deferral tax, this repatriation tax, can be deferred by an S corporation shareholder until a triggering event occurs. So if you're a shareholder in an S corporation, you have earnings from a specified foreign corporation that have not been taxed in the past, you have the ability via an election to defer paying the tax. You still have to calculate the tax due and the income and the tax due. However, you can defer it until a triggering event occurs. And a triggering event is simply a cessation of operations, a liquidation or sale of essentially all the assets of the S corporation, and transfer of any share of stock of the S corporation. We're not going to spend a whole lot of time dealing with this. We just want to make people aware that S corporation shareholders have the ability to defer paying the tax. Again, why this is, we're unsure at this point, because it kind of puts another level of inequality between corporations and individuals, and then S corporations in the middle. But that's yet to be explained by legislators. So finally, we want to get to an actual example. And this is a simplified example to illustrate how the tax would be calculated at the basic level. I say simplified because we're not taking into account any foreign tax credits, and we're not taking into account any ownership structure, whether we're owning this CFC via a C corporation, an individual, or an S corporation. So let's just dive into the numbers real quick and see how this works. As you can tell at the top, we've calculated the accumulated earnings and profits of the CFC or the foreign specified foreign corporation at $2 million. And then we've also calculated via detailed calculations the cash and cash equivalents of the same specified foreign corporation at $1,087,500. So first step is we subject the $1,087,500 at the 15.5% tax rate. This is a simplified calculation where we just show what the tax is, but if you go to the actual deduction to get to the 15.5% rate, you'll get to the same number, which is $168,563. Then the remainder, $2 million minus $1,087,500 of EMP, or $912,500, is subjected to the 8% tax, which is $73,000, for a total tax of $241,563. I will say that the higher the income tax rate in the foreign country, the bigger the foreign tax rates we can use. But there's still a haircut, and it is not guaranteed that all the tax will be eliminated. In fact, most taxpayers will have some type of toll charge. In some of our modeling calculations, we've seen that this tax due could be halved when we use the foreign tax rate, the credits, depending on the tax rate of the foreign corporation, of the foreign country. But that's a detailed calculation that is based on facts and circumstances, and we don't go into that in here. Vinay, do you have anything else?
I was just going to say, our initial stab at this example included the foreign tax credits, and it just got too unwieldy, so we purposely left them out. But the concept of foreign tax credits, at least at a reduced basis, does exist in this calculation. Now, out of the, and forgive me if I'm saying what you were going to say, Darko, but out of this $241,563 in this example, that would be the amount paid over the 8-year installment that we mentioned. And if I'm an S corp, I can elect to defer that.
Exactly. Yep. Agreed.
And just to go off on a tangent on New Jersey, one very real concern is that this 241 could be due all at once in New Jersey. And part of the thinking there is technically what happens for federal purposes is you're recognizing the income of the $2 million accumulated E&P in 2017. You're just making an election for federal purposes to defer this tax. You're calculating the tax on a form that we haven't seen yet of the 241, and then you're making an election to defer that tax. So it's a concern in my mind that some of the states could say, well, we don't have anything. We don't have a deferral mechanism like that for tax, but we are going to follow the federal system for the income, and therefore you owe this all with your 2017 return. I hope I'm wrong.
I hope you're wrong too, but if you look at the numbers, this is a 241,000 is a blended rate between the 15.5 and 8. If you're in New Jersey or any other of the coastal states, you're looking at about 8 or 9% on $200,000 worth, $2 million worth of income. So you'll easily get to this 250,000, if not more.
Mm-hmm.
Okay. So with that, we are wrapping up our repatriation tax section, and I believe we have a polling question. And the polling question is as follows: the maximum period over which the repatriation tax can be paid is A, 5 years, B, 7 years, C, 8 years, D, 10 years, E, all at once with the 2017 tax return, no deferral. And we'll give you a minute to post your answers. Okay, I think everybody has posted their answers, and it looks like 64% or 84 or 64? 84% of you have been paying attention and answered correctly, and the deferral or the spread period is 8 years via an election on the 2017 tax return. With that, we're going to jump into the next section, which Vinay will tell us more about the global intangible low tax income inclusion. Try saying that 5 times fast. But we have an acronym for you.
Yes.
And it's GILTI.
And as you can tell, the acronym implies that it's not a good thing. So what you see in the title, you see in parentheses inclusion. So there's 2 pieces to GILTI. There's an inclusion, an income piece, and a deduction piece. So we're going to focus on the inclusion, the income piece first. And now I'm going to give you a flashback to high school algebra. And here's the concept. Think of, on one hand, we had the extraterritorial, not the extraterritorial, the dividends received deduction that was enabling companies to get a tax-free dividend from their foreign sources. So think about the opposite side of the pendulum. It seems as if the policy thinking here is they wanted some sort of minimum tax to make sure taxpayers were not paying zero worldwide on income. And the word intangible is the I in GILTI, but kind of forget about that because there's no requirement that they be tied to intangible income. The concept here is if I'm making money in my CFC that's greater than a reasonable rate of return, I'm going to have this GILTI income that is subject to current U.S. taxation. Similar to Subpart F, whether it's dividend, brought back or not, I'm going to pay tax on it currently. So how do we figure out what's a excessive rate of return? Well, for purposes of the GILTI tax, I look at the adjusted basis of my fixed assets, and these are the hard assets that I'm depreciating in my business, not intangibles like goodwill or IP or things like that. For the most part, these are things that I can touch. And I look at the total cost of that for US tax purposes, and I take 10%. As long as I'm making as long as I'm below that threshold, I don't have a GILTI problem generally. But if I have an income of my CFC that's more than that 10% rate of return, this excess is going to be what we are going to consider GILTI income. So it's our new section is 951 Cap A. It applies only to CFCs, and that's what we just mentioned. It is GILTI income is eligible for a foreign tax credit, but the foreign tax credit is limited to 80% of the foreign taxes paid. So again, think of it like a minimum tax on foreign sourced income. And again, this 962 election, when we get into the details, is going to become very important to the GILTI calculation. So now we're going to go through a quick example. Oh, there's another slide. It's effective for tax years 2018. Now, I've talked about the inclusion. There's also for C Corp, and now the inclusion that we've spoken about applies to all taxpayers who own a CFC. So consistent with the idea of this law seems to favor holding item CFCs and foreign operations and C Corps. C Corps get a GILTI deduction, which is a deduction of half of their GILTI income. That's the new section 250, but that applies to C corporations only. So it really gives, again, it stacks the deck towards C corporations. Every state, we need to figure out, we don't know how states are going to treat this. We think that New Jersey probably does have a position to include GILTI income as in current New Jersey income as Subpart F, but again, the jury is still a little bit out on that. So let's go through our example. Again, we have two columns. Column on the left is a corporation, column on the right is an individual. We're assuming my CFC income is 100,000. We left out interest expense to keep the example easier to follow. The fixed asset basis is 120,000. So 10% of that is 12,000. So 12,000, if I earn 12,000 or less, I generally don't have a GILTI inclusion. But in my example, I've got 100,000 of income. So I'm in excess of that $12,000 threshold by 88,000. So if I look at my column on the right, I'm paying $88,000 of income, and at my individual rate of 37%, I'm paying a tax of $32,560. If there were foreign taxes paid on the 100,000, I would get entitled to a foreign tax credit, again limited to an 80% overall cap. So what happens if I'm a corporation? Well, I still have the same 88,000 of income, but I get a special deduction of 44,000, meaning that I have GILTI income of 44,000, and at the lower corporate tax rates, a tax of 9240. So a dramatic difference between corporate and individuals. So, as a practical matter, and this is kind of consistent with what I said about the repatriation, when we had CFCs that we know we're not paying dividends, we're not generating Subpart F income, there really wasn't a whole lot of thought that had to go through in looking at the financials of that foreign entity. We would basically take the foreign financials, report them on the Form 5471, and most of the time all was good. So now the rules have completely changed. I need to look at the P&L of my foreign subsidiaries far more carefully. I need to be sure to convert that trial balance on to a U.S. tax basis, as if that foreign CFC was filing a U.S. tax return, and do this calculation. So what used to be a very routine matter is now no longer routine. And like I said, the word intangible is here, but it just as easily could be a restaurant in a foreign country. There's no indication that it's intangible.
Yeah, I was going to
Darko?
add what is important also here. Another aspect of this is the fixed asset adjusted basis. We have to look at this as if these assets were depreciated under U.S. tax law, not a foreign law. So a taxpayer would have to go into the details of the depreciation schedules to find out what that basis is, net of depreciation.
Another practical aspect that applies both here and applies to the repatriation tax is the taxable year. So again, when you had a scenario where you didn't have subpart F income, you didn't have dividends, in many foreign jurisdictions, there is a non-calendar year end. So in India, for example, it's March 31st. Everything is March 31st. Individuals are on March 31st basis. Businesses are on a March 31st basis. And it could be that in the past, there was really no harm in reporting March 31st information with your U.S. tax return. Now there is an issue, because you have to look to Code Section 898, which tells you what your U.S. year end is of a CFC. And generally speaking, it's similar to the partnership rules that say that whatever your majority year end is of U.S. people, that's what your year end's got to be for U.S. tax purposes. So if you have a CFC that's owned by individuals, you have to make sure that you're reporting things on a calendar year basis, even though that may be completely different from what the year end is of that entity for foreign law purposes, for management purposes, for every purpose. Code Section 898 has always been there, and now it's, I think, even more critical as these computations really become part of our day-to-day life. So that was kind of the bad news about GILTI. Now we're going to talk about some better news, and Darko gets to talk about that.
Here's another new term for us, the Foreign Derived Intangible Income, FDII or FDII deduction. This new terminology is put in place, or new tax law, to kind of aid the U.S. corporate world for any income that is earned or provided in a foreign country. So let's just go through the slides real quick. I think we're running out of time, so apologies for going a little bit fast in these last concepts. It's a new section of the code, Section 250, which includes the FDII and the GILTI deductions, both. It is only available to C corporations, as we said, and basically what it does is allows a deduction of up to 37.5% of a foreign-derived intangible income of a U.S. corporation, creates an effective tax rate of 13.125% for that foreign-earned income. This 37.5% is only good through 12/31/2025. Then it goes down to 21.875, and correspondingly, the GILTI deduction goes down to 37.5% at that date as well. It creates a favorable tax rate for foreign-based intangible income and earned by U.S. corporations. And the word intangible is also misleading here, because it could be any type of income, including sales of product and services provided to foreign people. So in essence, it provides a export subsidy to U.S. businesses, and it may or may not be challenged in court by the World Trade Organization, as they have in the past for these types of subsidies. Without further ado, let's just go through the ninth grade math here in my visual here, so we can easily explain this this deduction. So FDII, or foreign derived intangible income deduction, equals 37.5% times the foreign derived intangible income. What is foreign derived intangible income? And that's on this bottom portion of the formula. The foreign derived intangible income, in plain terms, is the excess of the corporation's net income over the 10% of fixed asset basis, which we talked about earlier in the GILTI deduction of the corporation, as a percentage of foreign source income versus total income. What do we consider foreign source income? Foreign source income is any income that is a product or a service that is sold or delivered to a person that resides outside of the United States for the benefit and use in that foreign country. So if you provide services from the United States to a UK client, those services may be subject to this deduction or may be used as a basis for this deduction. And any product you sell, let's say you manufacture pens and you sell these pens to Spain, the percentage of the sale sold amount could be used as a basis for this deduction. In essence, it provides a deduction for companies that sell overseas or provide services overseas. It's important to note here that if you're operating as a branch, this deduction may not be available to you because branch income would be excluded from foreign source income. So the formula, as we saw, has similarities to the GILTI calculation. The effective date is tax years after 2017, so 2018 is the first year, which goes correspondingly with the new territorial tax system. And last but not least, there's a net income limitation where the FDII and GILTI deductions cannot generate a loss for the domestic corporation. That's kind of a moot point. And Vinay, do you have anything to add here?
Just kind of like an overall recap on this. So FDII and GILTI are think of them as opposites. FDII is really considered to be an incentive to bring foreign generating income activities into the U.S. and have them run out of a U.S. corporation. So that's why there's a benefit here to FDII. But again, we have a real difference in the type of entity we operate in because the FDII benefit is only available to C corporations, whereas GILTI income applies to all shareholders.
Okay, excellent. So I think we're ready to kind of wrap up or we have the final polling question, and it goes as follows. An individual taxpayer is subject to the following: GILTI deduction, dividend received deduction, FDII deduction, all of the above, or none of the above. So please take a little bit of time to answer that as quickly as possible so we can have a little bit of time to wrap up and hopefully answer some of the questions that you've posted in the questions pane. And I believe most of you have been able to, or 58% of you, are answering mostly correctly. And we'll close it in about 30 seconds if not all have answered. Okay. So I believe we've closed the poll, and 55% of you have been diligently paying attention with this complicated tax law and these new terms. But the answer is none of the above, because individuals do not get any of those deductions, or those three deductions. They're only available to C corporations. With that, we're moving into
Darko, so in the interest of time, why don't we go right to the kind of our planning opportunities? Because I think
perfect.
Out of everything we're going to talk about, that's the most important.
Agreed. All right. So just in a way of takeaways and planning opportunities, we may see a migration to U.S. corporations owning CFCs and other foreign entities rather than through individuals or S corporations.
And that probably should say U.S. C corporations. And as much as we're kind of saying that, there's a downside to having things in a C corporation. So that's a decision you cannot make in a vacuum. You have to look at a bunch of things like your exit strategy from your business and what makes the most long-term sense.
Exactly.
Okay.
We definitely should be looking into the Section 962 election for individuals that are subject to the repatriation tax and GILTI inclusion, so they can claim the deemed foreign taxes paid. And last on this slide is that we may or are seeing already an increased activity in the need for earnings and profit studies of these foreign corporations, and the time to do them is now. really we have through April 15th and then the extension period to figure everything out. And depending on the foreign country and other factors, it may be a big project. So next is Vinay.
So one thing we didn't talk about is check the box planning. Check the box is a part of the U.S. tax code that basically lets you, to some degree, decide whether you want your entity to be treated as a corporation or as a partnership with a flow-through taxation. And check the box applies to a degree to domestic entities, usually as LLCs, but it applies in a pretty big way in the international arena. So if I have a UK private limited company, I can make a decision whether I'm going to treat that as a corporation or as a partnership for US tax purposes. Now, by making a decision, it could have a tax impact one way or the other, but with these new rules that apply to CFCs, it may be worth looking to see, am I better off, instead of being treated as a corporation for US purposes, to be treated as a partnership for US purposes, and kind of avoid a lot of these rules. Obviously, as a partnership, I'm going to be paying flow-through income on everything, but then I also get generally a much more liberal use of my foreign tax credits I'm paying into foreign jurisdictions. So check the box planning, I think, is even more critical now than it ever was. And finally, another animal that we have not spoken about is called IC DISCs, Interest Charged Domestic International Sales Corporation, which is something that's also been around since the 60s or 70s, which is think of it as an export subsidy to allow U.S. entities who are selling tangible property overseas to really get effectively the difference between the top individual rate of 37% minus the top capital gain rate with the Medicare of 24%. So that rate break is something of value. So if you looked at the FDII slide and you said, this is something I could probably benefit from, but I can't because I'm a C corporation, then an IC DISC may be something to take a look at. So look at that. And with that, that brings us to the end, just 2 minutes over. So I appreciate your patience. I hope you found this helpful. And if you have any more questions, please send them over. And I'm sure we will be updating this webinar in time as we get new guidance from the IRS on how to implement these rules. Again, thank you.
Thank you all.